Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and welcome to another episode of Reverse Mortgage Radio. On the show today, we're going to be talking about 8 mistakes that all reverse mortgage borrowers should avoid. Now, obviously, you want to avoid all mistakes, but these ones we're going to be talking about today are the most prevalent, I should say, and probably things that are very easily avoidable. So if you have any questions about reverse mortgages, though, you can start by hopefully avoiding all mistakes by giving me a call. My direct number, well, actually, I've had some trouble with my main number that I usually give you, so I'm giving out my cell phone today. It's 303-513-2748. That is my cell phone number. You can reach me directly by dialing that number, 303-513-2748. You can also visit me online. Give me a visit at reversemortgageradio.net. reversemortgageradio.net. You can go there and download my free consumer guide. You can get a free quote on the page as well. All kinds of good information on my website at reversemortgageradio.net. Okay, obviously, we want to make sure that you understand reverse mortgages. That's a given. That's not one of the mistakes, doing something that you don't understand. But so let's just make sure that we do understand it. And what I usually like to do is start off the show by explaining what a reverse mortgage is. Most of the time, on most reverse mortgages, they are FHA insured loans. Now, not all reverse mortgages are FHA insured. They're the most common ones because they have the lowest interest rate and they fit most people. If you've got a $1.5 or $2 million home, you might want to take a look at a non-FHA loan because they provide a little more access to some of the equity that an FHA one doesn't, because FHA caps the value that we can consider when we're calculating how much we can loan you at like $1.2 million. Also, if you have a condominium, let's say you have a condo that is not FHA warrantable is what they call it. So in other words, FHA will not loan on any units in that condo complex. This proprietary program might be able to help you as well. Those are the two biggest issues that I see with people not using FHA insured loans. But again, we're going to focus on the FHA insured loans because they're the most common. Most people can qualify for these. And just so you know, the FHA insured reverse mortgage program is called the Home Equity Conversion Mortgage. Home Equity Conversion Mortgage, or HECM. The HECM is how we pronounce it. It's called a HECM. And these are the most common ones. They offer really good interest rates right now by comparison, lower than you'd get on a 30-year conventional loan, actually. And they offer a lot of flexibility. In a nutshell, the FHA insured loan is a loan that's specifically designed for people that are 62 and over. It allows you to convert a portion of the value of your home into money that you can use. As long as you live in the home, you or your spouse live in the home, and you pay your property taxes, your homeowner's insurance, you maintain the home, and occupy it as your primary residence, you never, ever, ever are required to make a monthly mortgage payment. And no one can ever come and evict you or take your house from you. There's so many misconceptions about reverse mortgages. So many people think that you have to give up title to your house just to get the bank or just to get the loan. And that is not the case. In fact, I was just talking to a realtor today. He's helping out a friend of his get a reverse mortgage. And we were talking and I explained to him again that reverse mortgages, the heirs inherit the home. when the homeowner passes away, the loan comes due. If you take out a reverse mortgage today and you're 62 years old and you keep that loan for the next 30 years, interest continues to accrue on the loan balance on a monthly basis. So every month you get a statement in the mail, and you're going to see two charges on that statement. One is for interest. The other one is for mortgage insurance. Yes, all reverse mortgages, all FHA insured reverse mortgages, I should say, have mortgage insurance. The mortgage insurance protects the lender. Wait. You pay a mortgage insurance premium every month. Well, you don't pay it. You're charged it. That was my fault there. You're charged mortgage insurance every month. And it protects the lender? Hey, wait a minute, Bruce. What's going on here? Well, it indirectly protects you, your estate, and your heirs. Let me explain. So every month you look at that statement and you're going to see interest you're being charged and mortgage insurance. The ongoing mortgage insurance is 0.5% of the loan balance per year. Let's say you've got a $100,000 loan balance. Over the course of the year, you'll be charged roughly $500. So you divide that by 12, and what's that, about $55 or $60, whatever the case may be, a month that gets added to your loan balance in mortgage insurance, plus whatever the interest is. That money goes to protect the lender in case you ever end up owing more on the home than it's actually worth. Most of the time, what happens with a reverse mortgage is you get a reverse mortgage today, you keep the loan, let's say 15 years. You're living in the home, you never make a payment, and you pull all the money out that's available. Let's say you qualify for $200,000 and you take it all because you have a big $200,000 mortgage we're paying off. Now remember, you're not having to pay that mortgage payment. So the mortgage you're paying right now, every month, you go get a reverse mortgage, and the reverse mortgage money pays off that existing $200,000 mortgage. So now, let's say the principal and interest on that $200,000 mortgage is $1,200 a month. You're keeping in your pocket $1,200 a month every single month, as long as you live in the home. The reverse mortgage loan can never be called due, and you never are required to make that payment. So remember, you're pocketing all this money every month. You're using it for other things, for your quality of life, to help family, savings, whatever it may be. And that money is yours. You're keeping it. However, you got to remember this. You're still charged interest on the reverse mortgage money. You're charged interest and the mortgage insurance. And what happens is every month you get a statement in the mail, or you look at it online, and you're going to see that loan balance getting bigger and bigger and bigger because the interest and mortgage insurance that you're not paying out of pocket gets added to the loan balance. If you live there for 15 years, it's possible. It's not likely because we don't loan a high percentage of the value. But it's possible you could end up owing more on the house than it's actually worth. So let's say you owe $500,000 now on this reverse mortgage, but the house is only worth $450,000. Your heirs inherit the home when you pass away. They inherit it, and they look at the statement. They're like, "Oh my gosh, Mom owes $50,000 more on the house than it's worth. That means we're going to have to pay it." That's not the case. They are not responsible. Your heirs are never, or you're never responsible for more than the value of the home. Let me repeat that. So basically, you could never have to be required to pay back more than the value of the home. If your home's only worth $450,000 and you want to pay off the reverse mortgage, your heirs want to pay it off after they inherit it, they can do a short sale, but that's not necessary. They could just sign it over to the lender and walk away. If they want to keep the house, they still can. They could go get a new loan for 95% of the $450,000 that's the value of the home currently, regardless of the fact that you owe $500,000 or $600,000 or $1 million on the house. they only have to pay 95% of whatever the value is at that time. So if the value is $450, they go get a new loan for 95% of $450, and the lender has to accept it. But now, wait a minute, though, because if the lender accepts that, then they're going to lose money, right? Because they're going to sell the house for whatever they can get for it, or excuse me, if they're going to have to write off that loan balance because $500 is owed on it, and they're only receiving $435 or whatever it works out to be. And so they've got $70,000 that they're charging off. Not necessarily, because the mortgage insurance is going to pay that difference. And that because the lender is not losing any money, they can never come after you, your estate, or your heirs for any loss. Hopefully that makes sense. Now, most of the time, what's going to happen is the value of your house is going to go up over 15 years, even though the loan balance goes up. And now you owe $500,000 on the reverse mortgage, but your home might be worth $800,000. Your heirs inherit the home for $800,000, sell it, say, for $800,000, pay off the reverse mortgage, and they keep whatever equity is left. Or if they want to go get a new loan, they just go get a new loan for whatever is owed against the property, and they can pay it off that way with the proceeds from the new loan. All right, let's jump into the meat of the show today. We're talking about 8 mistakes you want to avoid. Now, I know you want to avoid all mistakes, okay? But these ones are easy to overlook, but they're easy to fix as well. The first we're going to break it down into 2 categories. The first category are 4 mistakes people make before they sign on the dotted line to get the loan, in the process of getting the reverse mortgage, if you will. And then the next 4 are the mistakes they make after they have a reverse mortgage. So you want to pay attention, okay? Especially the part beforehand. Because if you call me, I'll make sure you don't make any of these mistakes, okay? You want to deal with a professional, somebody who specializes exclusively in reverse mortgages, and that's what I do. If you have any questions about reverse mortgages, please call me. I've been doing this for 22 years, and I've seen a lot of issues. Now, unfortunately, things change a lot, and I'm like, wait a minute, that issue I came across in 2015, but the rules have changed, so I got to go back and take another look at it. And I do. I know the rules, and whatever I don't know, I know people to call to get the answer, okay? So it's very important that you give me a call at 303-467-7821. So you need to give me a call at 303-467-7821. I'm sorry, that's my main number that I'm having trouble with. Call me on my cell phone. My cell phone number is 303-513-2748. 303-513-2748, or visit me online at reversemortgageradio.net. All right, let's jump into this now. Mistakes to avoid prior to the application or during the process. Number 1, when you're shopping around for reverse mortgages, there are some lenders, big ones, that require you to give them your social security number before you even know whether or not you want to do business with them, just to get a quote. You don't have to do that. Don't do it, in fact. If somebody asks you, you call up and you say, hey, I've got questions about reverse mortgages, and during the conversation, they end up asking you for they say, we really have to check your credit, and we need your social security number. Don't give it to them. Hang up. You don't need to do that to get a quote. If you're not sure if you have good credit or not, that's fine. You can still get a quote, and I would work up numbers a couple of different ways for you. One way is if you have excellent credit, or the acceptable credit, I should say. And then another one, if you have bad credit, this is what we have to do. We have to set up something called a life expectancy set-aside, where we take money away from the money that's available to you on the reverse mortgage to set aside an escrow account to make your taxes and insurance payments for you for the foreseeable future. What we call the life expectancy of the loan, not your life, okay? It's the life of the loan that we're thinking. So if you're 70 years old, we think you might live in the home another 12 or 14 years. We're going to have to take away 12 or 14 years worth of property taxes and insurance. That can be a lot of money. So you have to make sure, you have to have enough available in order for that to work. And that's what I explain to people. But I can do that based on what you tell me about your credit. And then if it looks like you want to proceed, then we'll pull your credit and say, okay, let me check to see if it will work or not. Okay? So don't give your social security number out. There's no need. Well, I swear, I've seen these big companies and they will, I go over to their house after talking with them because I like to meet people in person most of the time, and I explain how all the numbers work. So I show up, and they've got a big stack that they just received, a big overnight package from this company of, 200 pages of stuff. And they're like, well, they want me to sign this stuff. And I'm like, you don't even know if you want to use this lender. Don't sign it. Certainly don't give anybody your your social security number until you're going to do business with that one company. You don't need a bunch of people pulling your credit. All right. The other thing is, number 2, not working with a reverse mortgage specialist, preferably a certified reverse mortgage professional like me, Bruce Simmons. Okay. Really, it makes a difference. There's a lot of people, anybody who has a mortgage license can do a reverse mortgage. Do you want to work with somebody who's closed like maybe 5 loans over the last 2 years, 5 reverse mortgages? And they mainly work on forward mortgages, conventional loans, VA, things like that. And I could do reverse mortgages though. Well, they're the same ones that would call they say, yeah, I could do a commercial loan, or I could do a renovation loan, or whatever it may be, just because they want to get the commission. And even though they don't really understand what they're doing. Number 3, rushing into the loan, especially if you've experienced the loss of a spouse, for example. Now, I know sometimes, because like I did one loan for this wonderful, wonderful lady in Aurora. Oh my gosh, she is the nicest person. All my customers are nice, but she just stands out. Her husband passed away a few months before she called me. And her social security was like $2,000 and her mortgage payment was $1,800. There's no way she was going to be able to make this work. And then when her husband died, they took his social security away, and they took like 2 months before they started paying hers, because they took hers away too. And then they started paying her his, which was a little bit more, but still not enough. She had to borrow money from nieces and nephews. She didn't have any adult kids or anything. And she really, really, really needed to do the reverse mortgage because she wanted to stay in the house. And that's a unique situation. But it's best if you can wait to make any major financial decisions. They always say up to a year. Go through all the holidays and experience, the mourning process, the grieving process. You've got to get through that. You don't want to be making a mistake. And then who knows, a year from now, you may decide you don't want to stay in this house. Whereas if you got the reverse mortgage after 3 months, you wanted to stay there just because it would have been way too hard to clean everything out. But now you've got your kids helping or things like that. And it's just the house is too big, the yard's too big, whatever it may be. Try not to make a decision too quickly, and don't just rush into things. Okay. The 4th one is something that I forget to tell people all the time, and most people don't even think about it. You start the process for a reverse mortgage, and then you're shopping at Penny's, and they say, or Kohl's or wherever, they say, you know what, if you want, we can give you 10% off your purchase today if you apply for a JCPenney card or a Kohl's card or whatever, or your car breaks down. And you take it to the dealership and they say, oh, well, the transmission is bad. It's going to be $4,000. Well, you could buy this new car or a used car, say, for $24,000. Sure, why not? Go ahead and do it. But you're in the middle of this reverse mortgage. We do check credit and income. If you add a new payment, we have to calculate that in because we have to qualify you and make sure that you can afford to pay your taxes and insurance. Hopefully that wouldn't disqualify you, but it could. Don't do that, or call your lender first. Say, look, my car's in the shop. It's going to be $4,000 to fix this transmission, and it's just going to be better to get a new one. Is it okay if I apply for credit? And then they'll tell you, yeah, you can do that, and we'll just write a letter of explanation and figure it out. You qualify easily, so it's not a big deal. But if the money's really tight, that could be a big deal. You don't want to add an extra $400 car payment or something on there. All right. Those are the four mistakes to avoid in the process of the loan. Number one, giving your Social Security number out to everybody that asks for it. Don't do it. Number two, not working with a reverse mortgage specialist. You want to call me, okay? Just call me, 303-513-2748, and I can answer any questions you have about reverse mortgages. Or rushing into the loan. If you can avoid it, don't rush into it. I always prefer talking to people who say, well, I'm really just considering this. I don't need it. I'm not desperate. Some people say that, which is great. I always say that's good news. That's the way to buy stuff when you're not desperate. When you're desperate for that car because your transmission just went out, well, then you might make a bad mistake, okay? And number four, opening new debt while you're in the process of getting the reverse mortgage. So avoid those. Those are easy to avoid. All right. Now the four mistakes people make after getting a reverse mortgage and you can avoid. Number one, using the proceeds too quickly or all at once. The way reverse mortgages work, most of the time, it's there's a little bit of money left over. Let's say I can qualify you for $200,000. You have a $120,000 mortgage. Okay. You take out that $120,000. We eliminate your existing principal and interest mortgage payment. You're still responsible for your taxes and insurance and maintenance. But now you've got $80,000 in a line of credit. FHA has something called the initial disbursement limit. In the first 12 months of the loan, they don't allow you to pull all $80,000 out. That's not allowed. The reason is because back in 2008, a lot of people pulled out all the money at once and then they defaulted on their taxes and insurance. They couldn't afford to pay their taxes and insurance, and it was kind of a mess. So in 2013 or 14, I forget when, FHA put this rule in place where they say you can only take out 60% of the money that's available unless you're using it to pay off a mortgage. Then you could take out more and you can access an additional 10%. So in that scenario I just said, we qualify you for $200,000. You take out $120,000, that's 60% to pay off the existing mortgage. You can access another $20,000 in the first 12 months of the loan. If you don't need it, do not take it. Don't let anybody talk you into taking more money than you need. If you own your home free and clear, the most you could take of that money is $120,000. But if you don't need it, don't take it, because remember, you're charged interest on it. And there are lenders, loan officers out there that will try to talk you into taking all the money or as much money as possible out up front because they make more money then. Their commission is higher. Don't do it. If you only need $30,000 to pay off credit card debt or to fix up your house, only take out the $30,000. Don't let anybody talk you into taking out more because you're charged interest on it. Plus, you can leave that money in a line of credit that actually grows. So over the course of the next year or however long you keep it in there, it gets larger. You can access more of your equity that way. All right, that's number one. Number two, disregarding potential risks to non-borrowing spouses. If you can wait, it is always best if both homeowners are 62 or over. There's a rule called a non-borrowing spouse rule where essentially if you've got a spouse that's under age 62, let's say you're 65 and you're married to a 57-year-old, and you say, I want to do a reverse mortgage. It makes a lot of sense. Well, number one, we're going to calculate the amount we can loan you based on the younger homeowner's date of birth. That means you're going to get less money than you would if the person were older. But the thing is that the reason we do that is because that person can continue to stay in the property after you pass or you have to leave the home. And I could do a whole show on the non-borrowing spouse. In fact, I probably should update you on that. But if you can wait, it makes more sense because basically, let's say you get this loan in place today, and then you're driving down the road to your golf event or your luncheon, and you get in a car accident and you die. And you've got all this money in the line of credit. Your spouse has no access to that, because when you can no longer live in the home as your primary residence, that line of credit gets closed out. Your spouse can stay there. She can stay there, or he can stay there as long as they want. They have to continue to pay the taxes and insurance, but they're not a borrower. So they cannot access any of the money that's set aside in that line of credit. Number 3, not responding to the annual occupancy certification. Once a year, the lender or the servicer is going to send you a letter that you have to sign and send back saying you're living in the home as your primary residence. Or you could also call and verify it that way. But what happens is you get so much junk mail. Oh my gosh. I'm sure you get a lot now, but you get even more if you get a reverse mortgage. I'm sorry to say, I can't stop it. I wish I could. But and it could be very confusing. You throw away a lot of stuff, but you have to be aware that every year about the time you close on the reverse mortgage, so if you close on the reverse mortgage next month in September, then every September, roughly, you're going to get this notice in the mail. And you have to sign it and send it back, or call and say that you are living in the home. And if you do that, then everything is good. If you don't do that, they're going to send it to you again. And if you still don't do it, they're going to try to call you. And if you don't do it, then they're going to try to send somebody out to see if you're still living in the house. So you got to make sure that can happen, because if you don't get that back in time, you could get foreclosed on. All right. And the same thing goes with taxes and insurance or your homeowners association dues. You've got to keep up on all property charges. You are responsible 90% of the time. You're going to be responsible to pay your own property taxes and insurance with this loan. You've got to make sure that you get that habit to make sure you pay those on time. You could schedule an automatic deduction for your homeowner's insurance, but you cannot do that for taxes. Taxes are due in Colorado on I think it's February 28th, and then again June 15th, or all of it on April 30th. So half in February, half in June, or all of it by April 30th. If you don't do that, it's going to cause problems, because the lender is going to have to pay it, and then we're going to call you and try to get a payment scheduled where you have to pay the money back. But if you don't, then you could lose the house. You could be foreclosed on. Okay, hopefully that's helpful. The 8 mistakes to avoid. Number 1, don't give your social security number out to a lender until you just for getting a quote. 2, work with only reverse mortgage specialists. 3, don't rush into anything. 4, don't open any new debt before getting a reverse, while you're in the process of the loan. 5, don't use all the money at once if you don't need it. Don't pull it all out. Okay. Number 6, don't forget about a non-borrowing spouse. Now, that's not going to apply to everybody, but if you've got a spouse that's younger than 62, it does. And number 7, not responding to the annual occupancy certification. And number 8, not paying your taxes and insurance. These are easy to avoid. Just call me. My name is Bruce Simmons at 303-513-2748. 303-513-2748, or visit me online at reversemortgageradio.net. Thank you for joining me today. I hope you have a fantastic day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.